Hey, what's up, everybody? Welcome back to Investing Sucks. So, today I'm going to be doing a video on how public companies manipulate retail investors. So, when I started this channel initially about a year and a half ago, I had the initial goal in mind of trying to correct common misconceptions that people have about the world of investing. And it was around the time the whole GameStop saga was going on. And I saw a lot of people, particularly young people, getting into the world of investing. And especially in today's world, now that it's so accessible. You have commission-free stock trading platforms. You have fractional ownership, where, say, if you want to invest $50 into Tesla stock, you have the ability to do that. So today I'm coming back to my roots and I'm making a video talking about how public companies manipulate retail investors and essentially how a company that is otherwise unimpressive can do things like use marketing and buzzwords like innovation to hype and prop up their equity prices. And it's something that, with the rise of things like social media and really with the rise of the content industry as a whole, the way a company builds their public persona and the way they can get the general public to view them in a certain way can be extremely powerful. It can literally make or break companies. And there is a massive incentive for them to do that, because if you can convince retail investors that you're going to be tremendously profitable in the long run and you have some massive opportunity brewing, then you can basically get your equity prices to go up and it can really change your business. It can accelerate your whole growth strategy. It can make you invest in assets more easily because you're able to raise equity at higher prices, and it overall makes a huge difference. So what I'm going to do in this video is basically discuss framework that I have developed that companies use to accomplish this. And I'm also going to provide a live example of a company that is currently doing these exact things. So without further ado, let's dive into it. So this framework that I've developed has three main steps to it. And there's also a fourth step, which is kind of a bonus step, which I'm going to reveal at the end of this video. And this is a work in progress. So if you have something that you think should be added to this, which can help identify companies that are trying to mislead investors and artificially raise their equity prices by, again, using things like marketing and whatnot, then I'd really appreciate it if you would leave a comment and describe your own personal investing experience and something like that. I think if we can get a conversation going on that, it would really benefit the community as a whole. But here is the first step and probably the most important step, which is the company has to create a growth slash hype story. So the whole point is to make you feel like you're not just investing in a company for simply a financial return, but you're investing in some greater cause. Because what this does is it makes you feel less concerned with the actual financial metrics of the business, which is ultimately what matters for being paid back as an investor in a company. So you focus less on the number side and you're more concerned with the story of the company. So the qualitative side, the stuff that's a bit more difficult to measure. And if you're more focused on the qualitative side, you're more susceptible to place more weight on the sales pitch the company gives you. Whereas with numbers, they're more objective, right? It's really just with numbers. Are you making money or aren't you? Is revenue growing or isn't? Is profit growing or isn't? Those types of things. So that can take many forms, right? Some companies will discuss the innovation that they're doing. Some companies will use ESG related terms to make you feel like you're saving the planet by investing them. Sometimes index funds will even do this, and they'll use terms like emerging markets, ESG, like I said, innovation and growth to get you excited about investing them. And what's actually interesting is that there's pretty solid academic research that would suggest that even those marketing terms shouldn't even technically excite you because they don't actually lead to better financial returns overall. So, looking specifically here at investing in innovation. Now, there is well documented research that historically investing in innovation has been a terrible investing strategy just simply because investors tend to overpay for expected growth. So, when a company has a very uncertain future, meaning the range of outcomes that could happen is very broad, they could either be extremely successful, make tens of billions of dollars in the future, or they could go completely bankrupt. When that happens, investors do have a tendency to overpay for expected growth. And then once that uncertainty becomes less uncertain and the reality of the company sets in, then it can lead to equity prices falling pretty fast. And I think this is something that investors at present time are very aware of because we've seen this unravel in the past year and a half with companies like Netflix, a lot of these other, environmentally friendly companies, which we're going to get into one of them, which is the live example I talked about. And then also with emerging markets, they also tend to underperform due to investors similarly paying too much for expected growth because they have been labeled as emerging markets. And so there's that potential for a greater payoff, but also due to share issuances. And if you think about it rationally, what really matters for investors is not just growth in profitability, cash flow, whatever overall, but growth in cash flow per share. So it's what you actually get access to as an owner of that business. And what you tend to see in emerging markets is because they are probably a bit more risky, it's harder for them to raise debt financing, so they go to equity financing. And when that happens, the profit that the company then earns in the future, since they're issuing more shares, they're diluting the current shareholders, is split up between more investors, which actually leads to lower returns overall. And again, this is well documented, this is well researched, and what the research generally shows is that in economies that are labeled as emerging markets, they actually tend to produce lower returns than more mature economies, which I thought that was very interesting. So the whole point of me saying this is that these marketing terms that companies use, like innovation, emerging markets, whatever the case may be, they shouldn't even really excite you as an investor. When you hear those, you should think, well, based on the research that's been done into this topic, those don't actually produce great returns. So before I move on to the second step of the framework, I want to bring up the live example of a company that is actually doing this. And the company is called Sunrun. They are a US company that does solar panel installation for residential homes, mainly in the United States. And in the case of Sunrun, they use the guise of ESG to market their business to investors, which includes retail investors. And also, when I actually looked into them, the way that they funded their business was pretty esoteric and it was quite complex. So it kind of set alarms off in my head because it was the type of thing that really, unless you had training in finance and accounting, you weren't really going to understand what was going on here. So the average retail investor who doesn't have training in those types of things could see a company like this, see the way they market themselves, and think to themselves, by investing in this company, I'm investing for the greater good. I'm investing in the future. I'm saving the planet by investing in them. And to highlight the risk of why this is potentially problematic is if we look at the stock price here of what this company has done over the past 5 years, you can see a pretty sharp increase right here, followed by a subsequent decrease. And what I want to do is compare this to the book value of the company to see how it kind of lines up in terms of the actual fundamentals, right? So an actual tangible measure of business value rather than just marketing and that type of thing. So if I go here, I'm going to put in the capitalization of the company and then also enter the company down here so I can put in the book value. So enter this in and we can see how it kind of lines up. So the book value is in purple, capitalization is in green, and the book value jumped significantly here at the end of 2021. That was because they made a pretty large acquisition then, so that increased their book value a lot. But we can see in these early years here, they were typically trading below book value. They then went up a little bit. And then in this time here, they went up significantly and became very detached from book value. But since then, they've come down quite a lot and are back more in line with what we were seeing over here, where they're trading at less than book value. So this highlights the risk of investing in these types of companies, which is that if the story that the company is purporting, if the general investor mood towards that story suddenly reverses, then you can see pretty significant permanent capital loss. Because if you invest at a company at a high price, a price that's so high it's just detached from reality, that can lead to permanent capital loss if they can never actually get back to that point. Now, the way this company initially came to my attention was through an email list that I'm a part of a short selling firm called Muddy Waters Research. Now, this is a firm that may be familiar to some of you watching this if you've watched the Netflix documentary called The China Hustle, which features a man named Carson Block, who is actually the person that runs this research firm. He initially uncovered a lot of fraudulent financial reporting that was coming out of Chinese companies where they were basically just outright lying about things like sales they've made, assets they own as a way to swindle money from investors in Western areas. But his firm focuses mainly on short selling companies, specifically on companies that they think are being dishonest, misrepresenting themselves, or maybe even sometimes they think are just committing financial fraud, which isn't the case here. But they do think that Sunrun, like I said before, is using the guise of ESG to basically artificially prop up the company. And like we said, there's many benefits of why a company would want to do that, because in the case of Sunrun, they are a solar panel installation company. They do require a significant amount of assets to actually fund their business. So if they can raise equity at higher prices, then it's going to be very beneficial for them. So I will say that a lot of the research I'm about to show you specifically into Sunrun, I got from this report. Now, I do read these reports, but I try to take it with a grain of salt and not just take everything that they say at face value, because obviously them having a short position in this company, they are going to be a little bit biased, and they have themselves have an incentive to make investors believe that this company is not what they purport to be. So I'm going to take everything that I read with a grain of salt as I go through it, but there were some pretty solid points that they brought up, which shows that, there are some things that this company is doing that makes them appear to be dishonest. But before I get into that, what I want to do is go back to what I was talking about before and look at the marketing materials of this company so you get a better idea of what I mean when I say that the company is trying to convince investors that you're investing for a greater good and it's not just for a financial return. So this is their website here. You can see they've got a whole tab here on ESG, which, personally, I don't have a problem with a company marketing themselves this way. In fact, like if a company, specifically a solar panel installation company, is looking to raise money in the public markets, I would expect them to do this because it's in their best interest, like I said, and there's nothing inherently wrong with it. It's just the fact that some retail investors out there do not really have the chops to be able to adequately assess what they're looking at, and there is a chance that they might be misled. So if we go to this tab here called Why Invest, of course, the company's going to talk about their mission. And when you read this, it's hard to not to want to invest in them. And if we scroll down here, they even have a presentation which we can go through some of these things. We can see Sunrun is building the future electric grid. They've got this old world here, the new world here, which is Sunrun's in the center of this. Residential solar market is massive and underpenetrated. So they're talking about how it's going to grow in the future, how they can capture some of that market. They're saying they're the number one residential solar market leader, and this is the total spend. And right now, there's yet remains under 1% of the U.S. residential electricity market. So when you read these things, it's hard to not get excited about the company. And this goes on and on. There's plenty of slides here, and this is what the company's trying to do, right? They're trying to sell you on the opportunity of investing in them. Now, the second aspect of this framework is that they will invent new business metrics that tell you how to evaluate their business. Always be skeptical when a company does this. And they'll say that you can't use things like profit or free cash flow to evaluate our company. What you should use is some other metric that we created. And since we know more about our business than you do, you should trust us and you should use it too. And what you'll typically see with these metrics is that they're full of complex calculations and assumptions, because if they involve assumptions, then they can be overly aggressive with their assumptions, and most retail investors won't know enough about the business to be able to challenge them on that, and they'll just take it at face value and move on. And you may also notice the use of adjusted metrics, where they take a common metric like earnings or free cash flow and present to you an adjusted version of that. And since it's an adjusted version, there's no accounting standards they need to follow in its calculation, and they can basically just decide what they want to include or remove from those adjusted figures. Now, I will say for more recognizable adjusted figures like adjusted EPS or adjusted earnings, there are pretty common practices that a lot of companies will follow. They'll do things like remove non-recurring expenses like any expenses related to an acquisition. They'll remove share-based compensation. That's pretty common, although I would argue that that shouldn't be removed since it is a necessary business expense and you need to provide that share-based compensation in order to retain your employees, otherwise they'll leave. But there's no standards they need to follow. That's the main point. And when they make these metrics, they can decide what to include or remove. Now, this was a huge focus of the Muddy Waters report on Sunrun that I mentioned before. And if we go back to their presentation they showed here, specifically this slide here in slide 28, which is presented directly on their website, it's full of these types of metrics. And there's two main ones that you'll see here. One is on the right-hand side here, which they call gross earning assets. And the other one is over here, which they call net subscriber value. And these metrics are pretty similar in the way they're actually calculated. What net subscriber value is designed to show is the theoretical value of adding a new customer into their network. So if they were to add a new customer, this is the value that they bring. And that this is calculated basically by doing a discounted cash flow model of the money they receive in the future through the contract that they sign, which is the contract to provide them the solar energy that their panels installed in their house provides them. And then there's the creation cost, which reduces this value, which is things like installation, sales and marketing, all the costs that go into, I guess, acquiring that customer. So, and then at the top, they say here the total value generated of 200 million from these new subscriber additions here. which was just in this quarter. So if you're reading that as a retail investor, you're probably going to get pretty excited because you would interpret that as saying the business increased in value by 200 million just in the last quarter alone because of these new subscriber additions, and each new subscriber provides this much in value to the company. And then the gross earning assets are similar. They break them down in terms of how much they are expected to earn, again using a DCF model from the contracts that they've signed in the current contracted period and then in the contract renewal period. And then from that, they derive gross earning assets. They subtract all the debt the company has, they add back cash, and then they get net earning assets. So in a way, this number here is designed to show you what the actual value of the business is based on what they've done. So again, the issue with those is that there's a lot of assumptions that go into the model. And in this case with Sunrun, a lot of those assumptions were just way too aggressive and some just straight up did not make sense at all. So for one, I have a few listed here. The report went into detail on a ton of different ones that, because they broke down the model step by step. But a few of the ones that stood out to me was one, they assumed a 0% cancellation rate. And Muddy Waters stated that about a 3.75% cancellation rate is more likely. And a 0% cancellation rate is just not realistic, right? Because some customers, once they sign their contract, are going to move to a competitor if they see there's better technology out there. Some people just straight up won't end up paying for their contracts, which can happen for many reasons. So a 0% cancellation rate is just not likely. Another thing they assumed was a 90+% renewal rate upon the ending of the contract, which extends 20 to 25 years. So when the contract expires, they're basically saying that at least 90% of the customers are going to want to renew their contract, which doesn't really make sense because if you think about solar panel technology, it's one that has evolved very substantially in recent years. You look at how much a solar panel cost 10 years ago versus what it costs today, and it's night and day. The innovation there has been amazing, and a big reason for that was actually government subsidies, which is a different topic, but basically a 90+% renewal rate assumes that customers are going to want to stick with outdated technology, which is the current solar panels that they have installed once their contract expires 20, 25 years in the future, which doesn't really seem likely because there probably is going to be better options out there. There's probably going to be a new company other than Sunrun that develops something that is better in the market. You just don't know, and you can't assume that 90% are going to want to renew. And then the third one, which really stood out to me, was that they didn't recognize a liability, which Muddy Waters estimated to be in the range of $668 million, the present value of that liability, for the removal of the solar panels. Because as part of the contract, Sunrun does actually have an obligation under some of their contracts to remove the solar panels at their own expense. So this is a liability, and a competitor to Sunrun, a company called Sunnova, had a asset retirement obligation, which is the accounting terminology for this exact liability. It's a liability that a company has to basically pay money to restore something. In this case, it could be removing the solar panels once the customer no longer wants to renew their contract. And that liability was just not included. And the company is about somewhere between $6 and $7 billion. So a company of that size, a 700 million liability is pretty significant. So again, that was what the report stated. I'm not doing like my own analysis on whether or not I think that's accurate, but that's what the report stated. Now, one thing I will say is that these metrics that they are presenting, the idea is good in theory, but again, it's just subject to too many assumptions, and these assumptions can easily be inflated by the company and they can come across as too aggressive. And the average retail investor isn't going to have the knowledge of the industry to be able to challenge those assumptions. The only reason Muddy Waters was able to point out these things is because they're a large research firm. They have access to a lot of resources. They have a pretty strong network of people they can call. They even talk to former executives and former employees of Sunrun, as well as solar panel industry experts in order to determine this. The average retail investor isn't going to have those resources at their disposal, and they're probably just going to take what the company says at face value. And even if they don't want to take what the company says at face value, they have no idea how to actually go about determining if those is realistic unless they probably work in the solar panel industry, which is only a small handful of people. But most retail investors would see this and probably not even question it. They would see these metrics and say, I trust the company. I assume they have my best interests at heart. And ultimately, my goal here is to invest in the future. I want to, do ESG investing and make the world a better place. So I'm just going to go ahead and invest anyways. So the third aspect of this framework is the financial statements are going to include several esoteric and complex items. So basically, the financial statements are going to be full of things that you don't understand. Now, one of the old value investing adages is to focus on your circle of competence, right? And if you're trying really hard to understand, say, a business model or a financing agreement that a company has and you just can't seem to do it, then it's probably best to just move on, because if you don't understand how it works, then you won't understand how it could potentially hurt you in the future. And in the case of Sunrun, I tried to understand how they funded themselves specifically, and it was very complicated. And it's extremely important to understand how a company like this, which is a young company, it's still in the growth phase, it's an asset heavy business that needs to acquire assets in order to grow. You have to know how a company like that is funding themselves, because if they acquire a lot of these assets, which they were using debt in order to do that, and they can't earn adequate returns on those assets, then they won't be able to pay back their debt, and they could be left exposed into bankruptcy. And if you're an equity investor, then you could be left with nothing if the business goes belly up. So in the case of Sunrun, like I said, the way they funded their assets was quite complex. They used a few different things, but the one I want to highlight here is what they called tax equity. Now, I didn't know what tax equity was before I read about it with this company and in the Muddy Waters report. And to me, it seemed like a term that didn't really make sense, but it is actually, a legitimate thing that's pretty common in the solar panel market. And it's where you basically have an outside investor that will invest in a solar panel company that is eligible to receive tax incentives or tax rebates in the future. And they invest in the company now in order to have the access to those cash rebates later on. So how it works is basically these solar panel installation companies, they need help financing the cost of installation. They are subject to tax rebates, but they don't receive those into the future. So they'll get an investor to give them money now, and in exchange they give the investor the right to receive the cash that they'll eventually receive from that tax rebate at a discounted rate, obviously, so that it's worth it for the actual investor. And it's a pretty important thing for solar panel projects, because usually it funds about 30 to 40% of a solar panel project. So it's a pretty significant thing to know and to understand as an investor in a company like this. Now, the issue with tax equity, as pointed out by Muddy Waters, was that the amount of the tax credit they receive depends on the calculation of the tax base of the asset. And the IRS does not have a well-established formula for calculating the tax base, nor do they have any experience in the solar panel market to actually determine if the way a company is calculating their tax base, again, which the tax credit is based upon, whether or not that's actually accurate. So they're basically relying on Sunrun to teach them how to do their job for them. And as we've seen previously, Sunrun has a tendency to make very aggressive assumptions when they have the ability to. And the craziest example of this that Muddy Waters pointed out was how they included the value of the tax credit they'd eventually receive in the calculation of the tax base themselves. So to put that in other words, they're basically saying that US taxpayers should give Sunrun a tax credit on the value of the tax credit the taxpayers are already giving Sunrun. So needless to say, that doesn't really make any sense. And the fact that it's happening probably means the IRS is going to do something about it and put a stop to it, but that remains to be seen. Now, the bonus one that I wanted to talk about is if you see a lot of insider selling. Now, insider selling in and of itself is not always a bad thing. There are many reasons why people and company executives may sell shares in a company. But when you see only selling from multiple people in the company and it's happening very, very frequently, then it's a cause for concern, especially if it's a company that recently had a large run up and is starting to fall. If you're seeing only selling from a lot of people, it's cause for concern. So if we go back to Tickernomics here, we can actually view this data in Tickernomics, which I'll put a link to in the description of this video for this website if you guys want to check it out. This is a website that I created. But if we go to insiders here, we look down here, we can see some of the insider selling that's been taking place. And the type here, if it's an S, that means it was a sale. And we can also see the date here, the unit price, the amount that was actually sold, the quantity. So some of these quantities aren't too big. This one here was only about $4,000. But you notice a pattern, right? You only see selling, and it's happening pretty frequently. We can see 3 times in August it happened, a few times in July, many times in June, and it's only selling. There's no buying here. It's mainly just selling, as you can see here, and it's from a lot of people. You can see this, there's a chief legal people officer, executive chair, maybe some of the founders are included in here. So this alone is probably cause for concern. But like I said before, insider selling in and of itself is not a bad thing, but you have to take the context into mind. And when we take the context of what this company's stock price has done, where it shot up and now it's shooting down, to me, that is a little concerning. But anyways, guys, that pretty much does it for me in this video. I hope you did find value in this video. If you did, then please leave a like and subscribe if you are new to my channel, and I'll see you guys in the next video.